What if the next market crash doesn't ruin you, but makes you rich? When people hear market crash, they picture panic, empty homes, and shattered dreams. But the truth is rarely reported. Every major crash in history has triggered a massive transfer of wealth. Those who understood the pattern didn't just survive, they became extraordinarily wealthy. Look at 1929. Investors who bought during the depths of despair earned returns that would make today's tech billionaires envious. The dot-com crash in 2000? Patient investors who acquired quality assets multiplied their portfolios by 10, 20, even 50 times. And 2008's housing collapse? It marked the start of America's largest bull market in decades. Now we're on the edge of another financial precipice. Every major indicator, stock valuations, debt levels, corporate leverage, is flashing red. If history repeats, 2026 won't be just a minor correction. It will be a system-wide reset. The question isn't whether you'll survive. The question is whether you'll position yourself to profit. Crashes don't destroy wealth. They transfer it, from emotional to rational investors, from those who panic to those who plan. Understand what's happening beneath the surface, and you can be on the right side of the greatest wealth transfer. America's economic cycle follows a predictable rhythm. Roughly every 18-20 years, debt, speculation, and artificial growth collide with reality. We saw it in 1929, the 1970s stagflation, 2000 and 2008, and now again as 2026 approaches. The Shiller-Cape ratio, measuring stock valuations against earnings, is near its second highest level ever. Corporate debt is sky high. Government deficits are at historic levels. And yet mainstream experts say, no worries, the economy is strong. They said the same thing in 1999 and 2007. Both times they were catastrophically wrong. Meanwhile, smart investors are quietly preparing. Berkshire Hathaway holds over $300 billion in cash, its largest in history. Hedge funds are shifting into gold and other safe assets. Institutional money is rotating out of overvalued growth stocks into resilient investments. Unemployment is forecasted to rise, credit risks are increasing, and consumer confidence is cracking. These aren't abstract statistics, they early warning signs of a financial earthquake brewing beneath the surface. While most see crisis, the wealthy see opportunity. Crashes are not random. They're systematic transfers of assets from unprepared hands to those ready to act. History repeats. During 2008, millions lost homes and jobs, but some investors made generational fortunes. They bought real estate at 30 cents on the dollar, acquired stocks at bargain prices, and even entire companies for fractions of their value. Fear creates the best buying opportunities. During every major crash, quality assets, companies with strong balance sheets, essential products, and reliable earnings survived and often emerged stronger than ever. Real estate in prime locations retained utility even if prices temporarily fell. Precious metals maintained value when paper wealth crumbled. The difference between those who profit and those who lose isn't luck, it's preparation. Most people buy at highs, sell in panic, and follow emotional instincts. Successful crash investors reverse that logic, accumulate cash, research quality assets, and act while others fear. Dollar-cost averaging during market declines amplifies returns, but requires discipline. Buy more when prices fall. Buy less when prices rise. Ignore the noise of friends, media, and social pressure. This is exactly when fortunes are created, at the peak of fear and uncertainty. Cash isn't just safe, it's power. Liquidity lets you acquire distressed assets at prices unimaginable during normal times. Investors with cash from 2006-2007 bought stocks, real estate, and businesses at fractions of their value, creating wealth for generations. Diversification takes on a new meaning. Instead of spreading risk across asset classes, spread opportunity across different types of quality value. Avoid debt. It forces liquidation at the worst moments. Focus on businesses with strong cash flow, low leverage, and essential services. Government and central bank responses favor inflation over deflation. Holding cash alone is dangerous. Pairing liquidity with tangible, high-quality assets is crucial. International diversification also mitigates localized risk, exposing you to global opportunities. The coming crash will combine slow erosion and sudden collapse. Smart investors exploit both phases, borrowing cheap money to buy real assets, maintaining cash to acquire defaults, and avoiding investments that fail during currency debasement. Crashes don't destroy wealth, they reveal it. History proves this cycle. 1929, .com, 2008, all followed the same rules. And the next wealth transfer is being prepared right now. Educate yourself, build cash reserves, identify resilient assets, and act while others panic. The crash will arrive. What separates the rich from the rest is discipline, patience, and preparation. If you found this strategy valuable, hit like and subscribe to Finance History Vault for more insights that put you ahead of the next financial wave.